Hi everybody. So for the next half an hour, we're going to be looking at home buying and what you need to do to put yourself in the best position financially to buy a home. Now, regardless of whether you're looking to buy a home for the first time or if you're already a homeowner but might be looking to move in future, most of us need a mortgage to buy a house. And over the last few years, we've had stricter money lending rules that have come into place. So getting a mortgage is not as easy as it used to be. So we have to make sure that we're financially prepared so that the mortgage company will see us as a good borrower. So to that end, we're going to cover the reasons why mortgages are declined, then the best ways to save for a deposit and the other fees that you need to consider. Then we'll look at the new mortgages that were announced in the budget this year. And if you're a first-time home buyer, we're going to take a look through the Help to Buy initiatives available. And also, if you're a parent or a relative, we'll run through a few ways that you may be able to help as well. Then we're going to go on to looking at improving your credit score, and then finish off with how the pandemic has affected the home buying market. Now, although we're not specifically going to be going through the different types of mortgage available, we have included a glossary at the end, which is going to take us through those important points that we need to know. Okay, so let's get started then. So in 2020, the good news is that according to the Intermediary Mortgage Lenders Association, 4 out of 5 borrowers were accepted for a mortgage. But I thought what we should do is look at the reasons why 1/5 of people were declined so that we can avoid that happening to us. Now, as you'll see, there are several reasons listed here. Some of them are going to be easy to solve, like registering to vote. Some of them are going to take a little bit more time and effort, like saving for a deposit, making sure that our credit score is as good as it can be. So we're going to run through these things in order, starting with saving for a deposit. Now, last year, just for general interest, the average first-time home buyer was age 30. And the average house deposit in the UK was 20% of the purchase price. And the average house cost was just over £250,000. Now, if you already have a home and you're looking to move, the likelihood is that you're going to have some equity in your house. So that's the difference between what the house is worth and what your mortgage balance is outstanding. And you can use that equity to put down as a deposit on your next house. However, if you're a first-time home buyer, you're going to need to save for a deposit for the house you want to buy. And the really simple rule for deposits is that the more money that you can put down on a house, the bigger the choice of mortgage you're going to have available to you, and the lower the interest rate on that mortgage is likely to be. And obviously the good news for that is the lower the interest rate, the lower our monthly payments are going to be. And you tend to get the best mortgage offers with the lowest interest rates if you need to borrow 60% or less of the house that you want to buy. Now, one of the most tax efficient ways of saving your money is through an investment savings account, or an ISA, which hopefully most of you have heard of. And this tax year, you can save up to £20,000 into an ISA. Now, you can either save your money in a cash ISA, or some providers also offer stocks and shares ISAs too, to try to give you the opportunity to get a higher reward over the longer term. Now, the beauty of ISAs is that you don't get taxed on any returns that you make within that savings pot, and you can take your money out tax-free. But if you're looking to buy your first home, then you might want to look at a particular type of ISA called a lifetime ISA, which I've shown up on the screen here. And this is a government initiative designed to help you get on the housing ladder more quickly. Now, to open a lifetime ISA, you must be aged between 18 and 39, and you can pay in up to £4,000 a year into that, either as a lump sum or as regular savings, or as and when you can. And then the added benefit is that the government will add in a 25% bonus at the end of every month that you save, so it boosts your savings up. So once you've held the account for at least a year, you can then use that money saved to put down as a deposit on your house, as long as that house isn't worth more than £450,000. So as you can see there, if you can put in £4,000 in the year, the government pays £1,000, and automatically your savings are boosted up to that £5,000. So if you think you want to use a lifetime ISA for your first home, it is worth opening one sooner rather than later, just with £1, because it will get that clock ticking, and then you can just add funds to it later if you want to. As I say, if you're looking for your next home and you're looking to save more money to put down on that, then an ordinary ISA would be the place to save. Now, if you want to open an ISA or a lifetime ISA, Most of the major banks offer these, but their fees are sometimes higher than some of the app-based providers out there. And just like any other investments, you need to make sure that the fees you're paying for having that savings doesn't outweigh the interest or the investment returns that you're getting. So what I thought I'd do on this slide is just show you some of the more popular ISA and lifetime ISA providers out there. These ones are often chosen by beginners because they've got low fees, they've got low minimum investment required. Some of these providers offer cash ISAs, some offer stocks and shares, some offer the lifetime ISA. So just take a look through, see which ones might work for you. And you can also look at IMechE magazine. I find them brilliant. They've got some really good articles about, which lifetime ISA or ISA might work for you. Or you can look at some of the comparison sites out there to see what options are available. Now, whether you are moving house or buying for the first time, what we have to remember is it's not just the house that we need to save for, because the other fees that go on about moving house can be costly too. So I've listed some of them here. So for example, if you're selling a house through an estate agent, then you are going to be charged estate agent fees. And really that's for them to take photos of your house, to market your house, to arrange those viewings, and all of those things that they do to help you sell it. You should always ask estate agents to quote their fees up front, and don't be afraid to haggle or ask for a reduction. I find most estate agents are charging about 1% of the selling price at the moment, but I'm actually selling my grandfather's house at the moment, and I managed to get it down a little bit because they knew they already had a buyer who was looking for the house that I was selling, which means that they don't need to take as much time marketing the property. So it is worth negotiating on that fee, and also remember to ask, is VAT included? And see if you can get the total fee down, including that VAT, so it doesn't come as a last minute surprise. If you're needing a mortgage to buy your house, then you will be charged an arrangement fee for that mortgage once it's confirmed. Now that varies from lender to lender, but typically ranges from between £500 and £2,000. Now, rather than paying this as a cash sum, you are able to add that fee to your mortgage if you want to. And the upside of that is it does protect you from losing any part of that fee if the property purchase then doesn't go ahead for any reason. But the downside of adding it to your mortgage is that then you pay interest on that fee across the lifetime of the mortgage, so you'll end up paying more. So one of the ways around that is you might want to ask for it to be added to the mortgage sum, but once your purchase is complete, ask if you can pay that sum off now so that you avoid that interest going forward. The next one here is the valuation fee, because your mortgage lender is going to want to make sure that your property is worth what you're paying for it. Because then if you can't pay the mortgage for any reason and they have to repossess it, they know they're going to get their money back. Now, sometimes that valuation fee is included in the cost of the mortgage, but if not, you will have to pay that at the time the valuation is carried out. You'll also be required to have a survey on your house. Make sure that it's structurally sound and there's no problems. Things like rising damp or water pipe issues, because the moment you buy that house, any pipes on your land become your responsibility and your cost. So well worth getting those checked out. There's also the conveyancing fee. Now, when you buy or sell a house, you have to appoint either a conveyancer or a solicitor who will carry out all of the legal work required to register you as the new owner and to associate any mortgage that you've got on that property. Now, you can choose a solicitor yourself, or the mortgage company might recommend one, but it's up to you who you choose. I mean, from experience, personally, I tend to use a licensed conveyancer who specialises in this type of work, because I tend to find them a little bit cheaper than a solicitor, and they do this work day in, day out, and I find them get the job done more quickly. Now, in England, at the point that all of that legal work has been done and your mortgage offer is in place, then there is an exchange of contracts. And at that point, the house purchase becomes legally binding. Now, at any point up to that exchange of contracts in England, the seller or the buyer can withdraw from that transaction at any time, which is why actually people try to get to that point as soon as possible. And at exchange, the buyer normally has to pay a 10% deposit to the solicitor, and then they pay the balance on completion, which is normally 2 to 4 weeks later. Now, this is where the big cost comes in, because at the point of completion, there is a government tax that you have to pay when purchasing a house. Now, in England and Northern Ireland, that's called stamp duty, But in Scotland, it's called Land and Buildings Transaction Tax. And just to be confusing, in Wales, it's called the Land Transaction Tax. Now, all three of these tax systems will charge you somewhere between 0% and 12% of the purchase price of your home, depending on how much your house is worth. Now, normally in England and Northern Ireland, you start paying stamp duty if the price of your house is over £125,000. But the exception to this is if you are a first-time home buyer, in which case you don't have to pay stamp duty on the first £300,000 of your house. However, during the pandemic, during COVID-19, the Chancellor changed this, and in that nobody in England and Northern Ireland has to pay stamp duty now on the first £500,000 of their property price. And that is being extended now until the end of June this year, 2021. Then what's going to happen from the 1st of July to the end of September is that you won't have to pay stamp duty on the first £250,000 of your house. And then after that, it's going to revert back to its normal point. So you'll have to pay stamp duty on anything above £125,000. But for first-time home buyers, remember, you'll always get that £300,000 done. Now, you're going to need to have completed your property, the purchase of your property, by the 30th of September to benefit from that stamp duty relief. But if you think that all sounds really confusing, I need some clarity. So wherever you live, whether this is your first time home that you're buying or a second property, if you go onto the Better With Money website, we have got a stamp duty calculator on there. It covers Wales and Scotland as well as England and Northern Ireland, and it's being constantly updated in line with all of these different dates. So just put in how much your house is going to be worth that you're buying, and it will tell you the stamp duty that you need to pay. There's also a really handy calculator that I found on the Rightmove site, and this actually estimates your moving fees and all of those things that I mentioned in the slide before, depending on whether you're buying or whether you're buying and selling. So take a look at that website if you want an accurate breakdown. Now, as well as the stamp duty relief extension that the Chancellor brought in, he also unveiled in this year's budget a new scheme, which is designed to help anybody, whether you're a first-time house buyer or a second-time house buyer, anybody with a 5% deposit to get a 95% mortgage. Because what happened at the beginning of coronavirus is that 95% mortgages pretty much disappeared from the market. And that meant that there were many potential homeowners who suddenly didn't have any mortgage options because they'd only saved a 5% deposit. So what this scheme is trying to do is it's trying to encourage more mortgage lenders again to offer those 95% mortgages again. So for you, the home buyer, it just looks like any other 95% mortgage in that you put down a 5% deposit and then you borrow the remaining amount that you need from the mortgage lender. And then you pay that back over the agreed mortgage term. But for the mortgage lender, it has got the added advantage that it's being government backed. So if for any reason you didn't then keep up the mortgage repayments, the government actually covers a large proportion of any losses that that mortgage company might suffer. So the great news is that that scheme opened this month and it's running all the way through to December 2022, as I said, to encourage more lenders to give those 95% mortgages. But as with all government-backed things, there are a few rules that apply. In order to get these mortgages, it has to be your main residence. The purchase price must be less than £600,000 and you need to have saved between a 5% and a 9% deposit. And of course, you'll have to pass the normal mortgage affordability criteria as well. Okay. If you're a first-time home buyer or you've got a child that's looking to buy a house for the first time, it is also worth familiarising yourself with the government Help to Buy initiatives. And these were introduced really to help people with the smaller deposits to get on the housing ladder. Now, in England and Wales, there are 3 schemes, and I'm going to touch on them now. So these are the Help to Buy equity loan, the social home buy, and the shared ownership. Now, with the equity loan, this is great for first-time home buyers. You have to save a 5% deposit, but then the government will lend you up to 20% of the cost of a newly built home, which means that then you just need to arrange a mortgage for the remaining 75%. That government loan will actually increase to 40% if you're buying a new home in London. Now, there is a cap on the amount that the house can be worth, and that does vary by region now. But you can see all of those variations if you go on the helptobuy.gov.uk website. But for example, in London, which is the highest area in terms of cost of houses, the house can be worth up to £600,000, and you still be able to use that Help to Buy equity loan. Now, the upside of this one is that you're not going to be charged interest on that government loan for the first 5 years. And then hopefully by the time that those 5 years is up, hopefully your earnings may have increased, your house value might have gone up. So actually at that point, you can then look to remortgage to pay back that government loan. If you don't, then you'll just start paying interest, which is at 1.75% on the amount that they've given you. Now, the current equity loan offer actually opened just before Christmas. It opened on the 16th of December for new applications, and it's actually available. It's running through to 2023. So have a look for your local agents on the Help to Buy website that might be able to help you with that. The next government initiative is the Social Home Buy Scheme. So this is for people who already live in council housing and have done for at least 5 years. And what this does is it gives you the option to own a share or all of your property for a discounted price. So if you're in that situation, contact your local authority or housing association and see whether they've got that scheme and how much they would sell your house to you for. The last one here is shared ownership. Now, that allows you to buy a share of your house from a housing association or a house builder, but you continue to rent the remainder for them. And the hope is that that's going to keep the costs more affordable for you. This scheme is specifically for non-homeowners at the moment, and you need to be earning less than £80,000 a year. And again, you're going to need to have saved at least a 5% deposit and be able to pay for all of those moving costs. But once you've bought a share of the house, later on, if you want to and you can afford it, then you can start to buy bigger shares, and that's called staircasing. So if you're interested in any of those three things that I've said, take a look at the websites on the bottom. And if you want to know about similar schemes in Northern Ireland or Scotland, visit the websites that I've put at the bottom, and it has all of the Help to Buy initiatives in those areas as well. Now, one of the questions that we often get asked is how can parents or family members help first-time home buyers to get on the property market? Now, this is a stat I love. So last year, the Bank of Mum and Dad was the 10th biggest lender in the UK for mortgages. And the collective average parental contribution for home buyers was just over £24,000 a child, which I find staggering, and it must be skewed to people that are giving lots of money to their children. So if you're sitting there thinking, well, I can't possibly afford to lend or give my children that amount of money, or if you're the person that's hoping to borrow from family members, but you know they're not in that possession to lend to you, then there are some other options that you can consider. The first one is guarantor mortgages. So with these, parents can guarantee to meet any of the mortgage payments that aren't paid by the child. And that actually allows the child to arrange a mortgage based on their parents' income and assets as well as their own. So normally that means they can then borrow a higher amount. However, the guarantor mortgages can be risky for parents, particularly if they've already got their own mortgage on their own home that they need to pay as well. But with guarantor mortgages, you can normally borrow around 80% of the value of the house, and interest rates at the moment are around 2% for a 2-year fixed deal. Alternatively, you could get a joint mortgage. So this is where you could buy a house with up to 3 other people. They don't have to be members of your family. And in that case, all of your incomes and all of your outgoings are taken into account when calculating how much can be borrowed. But everybody that contributes is then named on the mortgage deeds. So if this was a parent helping a child, they don't necessarily need to live at that address. However, if you're doing a joint mortgage with parents or family and they already own a property, they will have to pay second home stamp duty surcharge, which puts a lot of people off, particularly parents, in getting joint mortgages with their kids. So the way around that is to have a joint borrower sole proprietor mortgage. This way, the buyer still has the benefit of using the parent's income for affordability, and both have equal responsibility to pay the mortgage, but it's only the child on the deeds. So that means that parents don't have to pay that additional stamp duty charge for having more than one property. But the last one I want to mention here, and I think this is the one I'm most likely to consider for my kids, and that's the family springboard mortgage. With these mortgages, the buyer has to put in a 5% deposit, just like with a traditional mortgage. But in addition to that, a family member, so it could be mum, it could be dad, it could be grandparents, aunts and uncles, they have to put 10% of the purchase price into a savings account with the mortgage lender. And that is used as security in case mortgage payments aren't made. But then after a period of time, normally 5 years, the lender will then release that charge and those funds to the parents or the family member, along with interest as well. So that money in effect is just being invested for that amount of time, and then it's returned with that interest as long as those mortgage payments are up to date. And then of course, once that money's returned, it can then be used for the next child, which is why it's become increasingly popular. Most lenders will only offer a springboard mortgage on properties up to the value of £500,000, but for most first-time home buyers, that is more than enough. And again, I found a really great guide at which.co.uk about getting mortgages and how parents can help. So that's well worth a read if you want to take a look. So that's really given you an idea then of where and how you can save that deposit and some of those Help to Buy initiatives that might be available. The next reason on the list, if we go down as to why mortgages are declined, is because the person applying is not registered to vote. Now, this is a really simple thing to sort out. The reason it's so important is because the details shown on the electoral register are used for your identity when you apply for a mortgage. And if you're not registered to vote, then you could either face additional ID checks, or the worst case scenario is that the mortgage lender just says, no, I'm going to decline you because I can't verify your ID. So this is simple to change. You just go onto the gov.uk website that I've shown at the bottom of the slide, and it takes about 5 minutes to do. The next really important thing on there is credit scores, and that needs to be as good as it can be so that it doesn't become a barrier to getting a mortgage. So we're going to look at that now. So the reason that a credit score is so important when you apply for a mortgage is that lenders are going to run a credit check on you. They're going to be looking at your financial history for the last 6 years, because what they're trying to work out is, are you a responsible borrower? Do you pay back your borrowings on time? Have you got any missed repayments? Now, your credit report is available through free apps, things like Experian, Credit Karma or ClearScore, and I've shown that the most popular credit apps here. What you'll need to do, choose an app, you go onto it, you register online, and then it will show you your credit score and how you personally are rated as a borrower. Now, each of these services uses slightly different scoring ranges, as you'll see at the bottom of the boxes here, but you'll be able to find an explanation of what your score means and whether that score is excellent, good, fair, or needs improving. And needless to say, the better your credit score, the better the chances you have of getting a mortgage. Now, in order to get your best credit score, you need to make sure that you're paying off your credit regularly, you're paying off credit cards in full each month, you're using less than 25% of your overall credit limit that's available to you, and also that you're not taking too much credit in a short space of time. So it's really best on that 6 months running up to when you know that you are going to apply for either a mortgage or a remortgage, that you avoid using things like overdrafts, you don't use short-term loans, you don't start applying for new credit cards, because all of that could work against you. So if you're sitting there and thinking, right, I've looked at my credit score and it's not looking great and I want to apply for a mortgage soon, what can you do to build your credit score? Well, firstly, just make sure that the information held about you on those files is correct. Now, you can either do that by going onto the credit score apps, or you can ask to see your credit reference files for free. If you think that any of the information held about you is wrong, you can write to the providers and ask for it to be changed. Now, if you've got a free credit score app with Experian, you can also use Experian Boost, which is number 4 on the list here. Basically, what that does is it gives Experian authority to connect to your bank account. And then what they'll do is they'll look for trends in your bank account that show strong payment histories. Things like you're paying into savings regularly, or you're paying your council tax on time each month, or even it could be that you're paying Netflix or Spotify subscriptions on time. If they find this positive information within your bank account, then they'll calculate a boost on your credit score and add it. And you could see your score go up by as much as 66 points. And that's particularly helpful for those people who, haven't either got credit facilities, things like a mortgage or a credit card already. Now, one of the things I've mentioned to build your credit score is to use a credit card regularly and pay it off in full each month. But if you're in the situation where you're not even being accepted for a regular credit card, then one of the things you might need to do is to turn to a credit builder credit card. So that's number 7 on the list. Now, this is a credit card. It does have a high interest rate. It could be about 35%, but it accepts people with poor credit history. But the point is that you use it each month, just little and often, and you pay it off in full each month, preferably by direct debit. And therefore, you're not going to be charged any interest, so it won't be a problem. And then that just starts to build your score. So in summary, find out what your score is and try to do a few of these things to see if you can start to improve your score before you apply for the mortgage. Now, we've covered most of the common reasons now why mortgage can be declined, not having enough deposit, not being registered to vote, having a poor credit score. But let's just finish off with affordability. Now, unfortunately, I can't give you any magic formula to get your salary increased, but what we can think about is how you can show the mortgage lender that you can afford the mortgage. Because when applying for that mortgage, the lender is going to request to see probably 3 months worth of your bank statements, because what they want to do is check the financial information that you're telling them. Making sure that you've got the salary that you said you had, checking that you've got the outgoings that you've said you have. And then what they'll do is they'll stress test those finances, which means that they'll make sure that you can still pay the mortgage that they're going to give you, even if there was a sudden change in finances, things like a rise in interest rates. So what you can do is make sure that you're keeping to a budget in those months running up to your mortgage application. So really that means getting a handle on what you've got coming in, what you've got going out, and making sure that you're spending less than you earn. Now, we've got some monthly and annual planners on the Better With Money website, which you're more than free to go on and print off. We've also got an online interactive budget planner as well. But all I'd say is, as you're trying to fill it out, be honest with yourself and see if there's any areas that you can save money. Things like shopping around for insurances to reduce premiums, making lunch rather than buying it out, or maybe even having a no spend day each week. Just having one less coffee out can actually amount to £130 a year. And all of that can improve your chances of getting a mortgage. If you want to check affordability for a mortgage, we've also got a great calculator on the Better With Money website, and that's a really good starting point. It'll ask you for your income and it'll tell you the kind of mortgage that you can afford. Now, before we finish, I just thought I'd touch on the impact that coronavirus has had on the housing market. Now, as it started back in April 2020, there was a dip in house prices, but after that, house prices started to rise again all throughout 2020. But what is going to happen this year? Now, originally, there was a pessimistic outlook and house prices, they were thinking it was going to fall. But now that the furlough schemes have been extended until September, and we've got that stamp duty relief that's been extended, there is more optimism that the housing market is going to stay buoyant. And actually, I was talking to your representatives at ICE before we came on the call, and we said in our own experience, we can see that house prices in our area are going up and there's lots of house sales going on. So Rightmove is the most optimistic, and that forecast that house prices are going to rise by about 4% this year. The pessimists are Halifax and the Centre for Economics of Business Research. They think that house prices might fall between 2 and 5%. Other things to watch out for because of coronavirus is that fewer lenders are now taking things like bonuses into account when they're looking at affordability for mortgages. Some are still taking into account things like regular child maintenance, but make sure that if you are getting child maintenance, it is clearly labelled on your bank statements. Now, if you know anybody that's been furloughed and they're looking for a mortgage, most lenders are only going to take that reduced salary that they're receiving and based on their circumstances over the last few months. But I thought I'd finish this slide on an upside. And the upside is that because the base interest rate is now at its lowest ever, it's at 0.1, it does mean that interest rates on mortgages have dropped. So it's cheaper now to pay them back. If you've already got a mortgage and you're out of your fixed period, it could be a really great time to remortgage now. You're going to be paying about £40 less a month for every £100,000 that you borrow than this time last year. So that is definitely the positive to end on. So we've now looked at ways that you can improve your chances of being accepted for a mortgage and the ways in which the pandemic is affecting the market. Now, although I'm not going to be going through the home buying timeline and all the terminology in any detail today, I just thought I'd put this slide up so that you can come back to it afterwards. I mean, generally, the whole home buying process can take anywhere between 3 months and a year on average, but it will really depend on how long it takes for you to get your mortgage agreed, how long you take to find the house that you want, and how long it takes to do all of the agreeing of contracts and the paperwork. But I've also put some useful websites and resources on the slides as well, so that you can find out about how to buy a house. And I have found that the Money Advice Services Guide is really great. Now, over these 2 slides, I've just done the mortgage glossary, so the different types of mortgages available, and I've also put a link to that Money Supermarket website, because I found their glossary to be the most helpful to understand. Okay, before we go to any questions, I just thought I'd put up the details of ICE Ben Fund and Support Network, because they've arranged the webinar today, and they're also going to add a recording of their webinar to their websites as well.